we'll go ahead and get started. Again, thank you everyone for joining us today. After our impact investing webinar that we had back in August, where we shared a number of different projects that we consider to be impactful opportunity zones investments, we wanted to dig in a little bit further around the evaluation of impact in opportunity zones investments. And so today, I'm really excited to have two folks who I really think are thought leaders in this space, are helping to push the market forward. So number one, Jeremy Keel from Catalyst Opportunity Funds, and then Reed Thomas from NES Financial. They're both going to provide presentations around how they are helping to contribute to the area of impact measurement and monitoring in this space. But before we get started, I'm going to do a few housekeeping things and then go over the agenda. So number one, as always, this webinar is going to be recorded and we will post a post-webinar blog on our website. So you'll have that to reference as much as needed. If you have any questions, please put them in the Q&A box and we'll do our best to answer those throughout the presentation, but there will also be a dedicated portion of the webinar where we will address audience questions. And please stay on mute. And with that, I think we can get started. Next slide. So for our agenda today, and this is not necessarily in any particular order because both guest speakers are going to speak to a number of items that we have listed here. But, we're going to talk about what is impact investing. And then, what are the different efforts that were established early during market formation? So right after enactment of the policy to help inform the deployment of opportunity zones capital. We'll talk a lot about double bottom line investing. And so I wanted to quickly touch base on what that means. Many of you may already know if this webinar was of interest to you in the first place, but double bottom line investing is investing to achieve both a social and financial return. We're going to talk about evaluating social impact. So what does it actually mean, on the front end to create frameworks or scorecards that help you filter and screen opportunities, so investment opportunities, to ensure that they're aligned with your investment thesis or your investment strategy around the outcomes that you want to create in communities. And then, of course, at the back end, how are you evaluating progress towards your goals? And how are you making that transparent for investors? And then we're also going to have like a back and forth dialogue between Jeremy and Reed around demand for high impact investment products and what investors are saying around the level of transparency that they want, as well as how investors are generally behaving in the marketplace when it comes to this sector around impact investing with opportunity funds. And we're going to open it up for the last 10 minutes for Q&A. Next slide. So to begin, I wanted to just again give everyone, some level setting around impact investing. I'm going to read straight from the slide here. So investments in companies, real estate assets, and managed funds with the intention of generating social or environmental impact alongside a financial return. So that gives you an idea of what we mean when we're talking about impact investing. There's impact along a spectrum of from passive to active and intentional. And there's also different expectations around financial returns. One of the best graphics that I've seen to explain this is this graphic from the Bridgespan Group. And you can see they have this plotted out, your approach to impact and the expected financial return, and then the different products or initiatives that are available or have occurred within the broader marketplace. And so what I've done here is in this orange box, I've kind of highlighted, my own personal perspective around what I've seen in the opportunity zones marketplace. So investments that are anywhere from, there's really no approach to impact, but they are expecting a market rate return, all the way to, on the right-hand side, folks are being very intentional about impact. And some are still expecting a market rate return, but then others, may take a concessionary return or a below market rate return. Obviously, that's not the majority of the market, but it is happening. What I've done with this squiggle orange line there is point your focus to this box that says intentional market rate impact investments. And I think this is the area where I would really love to see the opportunity zones marketplace move in mass. And so just wanted to ground the conversation in that. Next slide. So a big thing that if anyone's ever heard me speak, I talk about intentionality and the fact that intentionality drives impact. I really believe that in order to have the outcomes in communities that are aligned with the Opportunity Zones policy, fund managers and investors have to be really intentional and bake that into their impact strategy, their investment strategy, and their investment thesis. And so that looks like right at the outset that you know what you want to do, you adhere to certain principles, and that flows through all the different activities that you're going to engage in. And so doing like sort of a step-by-step analysis of how that works, first you determine the social or environmental issues that you want to address, and then identify the investment activities that can create an impact. And so obviously if you're concerned about issues like homelessness or household budgets and ensuring that there are affordable places for folks to live within communities, then that would be the issue you want to address, and then identify the investment activities. You may want to invest in affordable or workforce housing. That's a really easy one. But then after you know what you want to do and what sort of activities you can engage in order to move the needle on that issue area, then you can use the investment activities that you've identified to build a framework for screening investment opportunities. And there's a really great one that we're going to cover later on. So that'll be a good example. And then what you also want to do is kind of identify the KPIs or the key performance indicators tied to the impact that you want to achieve. And so whether, if it's affordable housing, if one of your KPIs can be the amount of money each household is going to save if they were spending, 30% of their annual income on housing, what if they moved down to 20%? And what is that delta, and what could they potentially do with that additional money or that additional savings? One of the things that we've done, we've developed a few investment profiles, and we're about to release some more where we outline some impact projections. And so there's a number of different ways. If maybe you've just, closed a transaction and you want to tell your story, but it's a little too early in the project life cycle to start talking about outcomes, then you can talk about, what are your economic projections or your social impact projections. You can do this qualitatively. So using testimonies from local officials or the beneficiaries. So either small businesses that are moving into a building or residents. And you can also do some quantitative measures around this. And so what we use for our profiles, we use two multipliers, which we've identified here. One is the Economic Policy Institute. They have a multiplier around jobs. We use that a lot to determine indirect jobs that will be created. And then also the National Association of Home Builders. They've just updated their model that allows you to plug in, I'm creating a multifamily building with 100 units. What is the projection around jobs created? What's the projection around local revenue that'll be driven by this project year over year? So those can be really useful tools that I just want to identify. And then once the project's finished and you want to track impact year over year towards your goals, again, qualitative, you can use surveys and you can interview the beneficiaries both in your project as well as around your project or the businesses that you've invested in. And then quantitative, something I just want to flag here is that, sometimes measuring outputs, so like the number of homes created or the number of seats that are created if you invest in a school, sometimes the outputs are really great, but a lot of folks want to dig deeper into the actual outcomes. So what is the benefit to the folks that are populating or frequenting the asset that you've invested in, and get to the actual outcomes that are different than the outputs. Next slide. So this slide, I kind of went into a what do you call it, like a wormhole or the rabbit hole. I went down the rabbit hole on this slide, but I think it hopefully is helpful. because I get the question a lot of times around, I have this project. Um, what should I be saying around the stakeholder group? What should I be saying around the need? How do I quantify the need? And also the outcomes that we were just talking about. So this is using a framework from the Impact Measurement Project, and they call this the Impact Measurement Norms. And I've linked it there on the slide. But those are the 5 dimensions of impact, and I just want to walk through this with you. So if you're a fund manager, so an opportunity fund, and you invest in a new building, so new multifamily residential, say it's 200 unit apartment, where there's a set aside of 60 units that are going to be reserved for households earning up to 66% of area median income. That's kind of like our activity, our use. And maybe the project sponsor is a nonprofit developer with limited cash and limited access to investor networks. So just saying that and saying that they could really benefit from an equity investment, or else they'd probably have to come off a balance sheet in order to accelerate this project or advance it. And then the AMI in, pick any city is $100,000 for a family of 3. That's sort of like our use case here. So when you're talking about what outcomes are you contributing to, and you got to think about that, whether it's both positive or negative, because every investment has an impact. It's just, is it a positive impact or a negative impact? And then how important is the outcome to stakeholders? So saying in this city that affordable housing is a priority for both residents and elected officials. So you got your activity, your use, as well as your stakeholder group. You want to identify which stakeholders are experiencing this outcome and how underserved they are in relation to the outcome. So the stakeholder group is these households of 66% AMI. Quantify it, there's 5,000 households in this community. So there's a need or a affordability or opportunity gap of around 5,000 households. And then they're paying 40% of their income each year on housing. So that's to say, typical measures around affordable housing is that you want to only be paying 30% of your AMI on housing each year. And so if they're paying 40, then they're deemed as being housing burden, or they have a housing burden. So that's kind of your stakeholder group. And then you're building 60 units. And so the number of households that you are potentially impacting are 60 households, and you're going to reduce their housing expenses to 30% of AMI. Once you do the calculus, what you'll see is that it backs you into the ability for these households to save $550 a month, or $6,600 annually. And so you start thinking about, what could a family of 3 do with, over $6,000 in savings each year? They could potentially, it could go to savings. It could go to help boost the local economy because they're able to purchase more things. It could help with potentially, sending a kid to school. So what's the price tag for local community college? So you start thinking about, what's the benefit here? It's more than just affordable housing. It's all these other things. And then because we're talking about the duration of what this could potentially be and how long it'll benefit this group, I just say, like, we do a 10-year LURA, so a land use restriction agreement. So it may not be the same 60 households, but it'll be a finite amount, 60 households that you can be benchmarking. Is there a but-for case? But for this activity, would this have occurred otherwise? And so you want to see, are there any new starts that are in the pipeline around housing that would serve this market? If there aren't, then you can say that there's a real but for your investment, this target market wouldn't be served. And then any sort of likelihood that the impact would be different than expected. So maybe some of these households start earning more than 66% of AMI, maybe some of them start earning less. All of these sorts of things will change your variables and your ability to quantify impact. But I'm going to move on from that slide. Hopefully it was helpful. More to come there. So just really quickly before I turn it over to Jeremy, efforts to inform deployment of opportunity zones capital. So two of the hallmark efforts that I want to note that have been used by multiple stakeholders. Number one is this OZ framework that was developed early on, right after enactment, so 2018, 2019. And it really provides, what are the common metrics that you can use to evaluate the type of impact that you're having on a project. They talk about the need to identify responsible fund exits. And then also they provide a template for outcomes reporting. So in case you want to provide investor reporting, they have a template there for you. And then Urban Institute also developed the Opportunity Zone Community Impact Assessment Tool. And it helps, both project sponsors and investors, as well as local leaders, determine how an investment may positively affect the community. And so that's another tool, if you're looking at a potential investment and you want to understand what that impact could be, that assessment tool is available for you. Some examples that I want to share really quickly is that Arcturus Impact Investors, they're using a third-party group called ICIC to do their impact evaluation. The Pearl Fund is including quarterly reporting requirements in its term sheets. And so everyone who receives investment from them has agreed to provide data on a quarterly basis. And they've also included within their term sheet this language that I've provided in case anyone wants to copy that, or I would say, replicate that action there. And then Woodforest CEI Bullis Opportunity Fund, they went so far as to create a social impact advisory board, which they use as one of their screens for investments. So they provide feedback on potential investment opportunities. And they're also utilizing the OZ framework for their impact evaluation and reporting. And with that, I will hand it off. This is the main event here, Jeremy and Reed. Jeremy's going to go first. And as I just provided those examples of funds that are doing great work, this is a continuation of that. So some more examples of opportunity funds doing great work in the impact space. Jeremy?
Thanks, Rachel. Good to see you. Good to be with everybody. Really grateful to EIG for putting the webinar on. I've been in impact investing for the better part of the last decade, and it's really gratifying to see this conversation kind of go into the mainstream, and in particular in the context of opportunity zones. So this is a great conversation for me to be a part of. So Catalyst, I co-founded and run Catalyst Opportunity Funds, which, as Rachel mentioned a minute ago, is kind of an impact-focused private equity fund platform. We've raised about $125 million to date. And really all of that for opportunity zone investing. And I would say that really the key to our success, and getting to kind of the theme of the webinar, the key to our success to date has really been a disciplined focus on impact in opportunity zones. And I'll kind of unpack what I think that means, at least in our context. It's a non-concessionary offering. Rachel talked about the difference between, kind of making trade-offs for impact in terms of financial returns. From our perspective, we think we can have both. We can have, market rate or better, financial returns alongside community impact. And I'll tell you about kind of some of the strategies that we use to get to that. So what I want to do is I want to start just with a kind of quick, overview of our strategy, and then really get into kind of the impact thesis that we have. And then, really end on kind of the impact framework, like measurement framework that we have in place that we've developed and spent a lot of time on. And then really sort of wrap it up with a couple of very quick case studies on kind of how this all gets applied, in practice. So really what the strategy is here, we're mainly focused on real estate investing. We've done very recently a couple of small company investments, but we're mainly focused on real estate investments. We're based in Salt Lake City and Austin, but we're working nationally. And the model on the real estate side is to partner with best-in-class community-driven developers and become kind of the LP, capital partner to those place-based developers working in their own communities. So that's kind of our model. The impact strategy, as you have here, is really built around these kind of four pillars. One is affordability, which is top of mind for, almost any community stakeholder in any community across the country, as I'm sure you're aware. The next pillar is, economic development and how you support small businesses, local entrepreneurs that are trying to get businesses off the ground in these communities. How does the built environment kind of support that effort? The third pillar is access to services. So thinking about healthcare, education, nutrition, affordable grocery, professional development, all those kinds of things that can actually be programmed into a community and provide real benefits and amenities to an otherwise amenity sort of constrained environment. And then the last one is environmental sustainability, both in the construction and design, but also in the operation of the real estate. Let me just see if and I guess what I wanted to emphasize here before we go to the next slide is that, again, we're looking for win-win opportunities where you don't have to make sort of trade-offs on the financial side in order to get this community benefit. And so, if we had more time, I could walk you through each of the categories of impact and talk about kind of the sub-strategies for doing that. But just a couple of really quick examples, healthcare services, preventative healthcare services in medical deserts, in resource constrained environments, like that's a big issue, nationally. We're working on some projects where we have big, credit grade health systems that are fantastic tenants, long-term tenants signing long-term leases, but they want to put preventative healthcare services into these communities. From my perspective, that's a great example of a win-win, because that's a perfect, credit grade long-term tenant to have in your real estate, but it's also a huge win for that community. I think workforce affordable housing is another great example of this, and people are talking about this a lot. It's an example of something, as Rachel, indicated a minute ago, a huge and growing need for, housing for kind of that missing middle demographic, but it also turns out to be a great price point to offer real estate at. So if you can actually build a project to a price point that you can offer, workforce attainable housing, there's very inelastic demand for that, for that category of housing, and so it leads for a very, it leads to a very sort of resilient product type. So we look for those kinds of win-wins. Next slide, please. This is just a quick overview of kind of the markets that we're in. Basically focus on high potential, secondary markets, mainly off of the coast, places like Salt Lake, where I live, that have, really sort of good fundamentals and diversified economies. But within those markets, we're looking for sub-markets that have really kind of historically been, underserved and passed by, and finding development sponsors in those communities that are doing really impactful, community-driven projects in those neighborhoods. Next slide. So this is how we think about the kind of the capital stack. And I think this is one of the innovations that we kind of bring to this work. Typically in a real estate development deal, you think about equity and then debt, and it's pretty, cut and dried. We think about that a little bit more holistically, and we've, I think, been able to really successfully leverage our networks in the public sector, in impact investing and philanthropy, and other contexts to kind of bring in different types of capital that can sort of enhance the impact profile of the deal. But I would also argue the economic profile of the deal, and we've got lots of sort of examples of this in our portfolio. Next slide. This is really kind of the meat of the the presentation, and really the framework that we created around impact measurement. As Rachel said a minute ago, there's a lot of groups that are doing things with scorecards. This is an example of our scorecard, but there's a lot, like anybody that just suggests that all you need to do is put a scorecard in place and then you're kind of good to go, has not really fundamentally understood the challenge associated with doing this work. And so we have a 3-part framework that we've developed, and the scorecard is one part of that, but it's just one part. So really on the front end of any investment, what we do is a community needs assessment. Rachel talked to that as well. We've created our own, and we basically tie into about 25 different publicly available data sets that cover socioeconomic data, demographic data, education attainment, health and wellness, nutrition, other types of statistics. And we can literally type a property address into that spreadsheet and, get information on what that community looks like currently using those publicly available, data sets. So that's really, phase number one is doing that community needs assessment. Phase number two is doing the scorecard that you're looking at right now, which you'll see we have 7 categories of impact. Within each of those categories, we have a number of subcategories. And then behind each of the subcategories, which I'm not showing here, are really a set of kind of objective indicators. In almost all cases, something that's either binary or formulaic, so that if I went and scored a project and you went and scored a project, hopefully we would get to the same score because we kind of reduced everything to a very formulaic, objective, data solution. And then really what we do is we take the score that comes out of that and we take that very seriously, and we have a minimum score threshold and have sort of imposed on ourselves a little bit of discipline to just pass on deals that don't meet that sort of minimum score. And we have lots of examples of deals that we have passed on just because because it didn't meet that impact score for us. So we think of the scorecard as kind of an impact underwriting tool, if you will, on the front end of any investment. And then the last piece of the framework is really kind of an impact dashboard, which you're hearing a lot about these days. It's sort of post-investment. What are the metrics that we're going to work with the developer to collect regarding both the community, so some of those broader kind of community outcomes that Rachel described a minute ago, but then also a lot of kind of outputs that come from the project itself. So really being balanced about tracking both of those and putting systems in place with the developer in our asset management agreements with them that allow for the data collection to sort of facilitate the analysis that we want to do. And then we put that into a dashboard and read that out to us as kind of capital allocators and managers, to the developer partners, to the community, to our investors, et cetera. And that's that transparency piece that Rachel talked to a minute ago as well. I would say of the 3 sort of pieces of this is by far the hardest, because you can start, there's lots of data banks of, impact metrics or community metrics out there. And you can go take a look at those and you can pull, those metrics down, but then putting those into practice and actually sort of designing, data collection methodologies that can allow you to kind of tease that information out of the investment over time, like that's where the real work is. So it's something that we spend a lot of time on, and we're really excited about. We're actually hiring a position specifically for this. I've just been doing this kind of in my spare time, and we really need a dedicated position. So if anybody's interested in kind of doing this full time for a group like ours, would love to connect with you. Next slide, please. Just to wrap up here real quick, I wanted to kind of share a couple of examples of this. And this first one is actually a project that we closed on in September, so just about a month ago, and broke ground on in September. It's in South Minneapolis, which has been in the news a lot recently with the shooting of George Floyd and some of the civil unrest that followed. So this is just a few blocks from kind of where a lot of that stuff happened. It's a large immigrant and refugee community in this neighborhood, mainly Somali. We're building a workforce through our developer partner. We're building a workforce affordable project here. 100% of the units are at 80% of area median income. And this is really, and I think a good example of kind of how you leverage other things happening in the community and kind of this ecosystem of amenities and services to bring real impact. But this is really the last phase of a very thoughtful, multi-decade long kind of master planning and master development effort in this neighborhood. So right across the street from this project is a deeply affordable senior housing project. Right across the street in the other direction is a deeply affordable housing project for folks suffering, with mental health issues. And then sort of catty corner to this, there's a business incubator that's targeting mainly, women and minority-led businesses in this refugee kind of dominated community. So really kind of high impact profile across the master development. This is the last piece, which is that workforce kind of attainable housing. And so that's the piece that we invested in specifically. The way that we score this, I won't go through the scoring in any detail, but just to call out a couple of things, as I said, the master developer for this project is a Somali refugee herself. The for-profit developer that we're partnering with has also partnered with a nonprofit kind of community group called Seward Redesign. So really sort of impactful kind of public-private, not-for-profit partnership here. It doesn't score high on economic development, just to take one example, because it's just a single strategy. It's a housing project. It's not trying to be, a business incubator or, workforce training, facility or anything like that. And that's okay. Not every project has to score off the charts in every category. Sustainability, again, doesn't score terribly high here. It's really hard to do affordable housing when you're also trying to do like a net zero construction. And so, in some cases you have to kind of pick your battles. But that hopefully gives you a sense of kind of how we think about the impact underwriting on a project like this. Next slide, please. And I'll wrap up with this. This is another project, sort of on a de-identified basis because we haven't closed on it, we haven't capitalized it yet, but we're getting very close to doing that. But it's in one of our target markets. It's an adaptive reuse of a really kind of interesting commercial building. It's an old, cereal granary. We are partnering with a LIHTC developer on the same parcel. And I think this is, again, sort of an example of kind of an innovative capital stack. We're ground leasing the adjacent the adjacent space on the same parcel to a LIHTC developer who's building 2 LIHTC towers here next to this. Once the tax credits are sort of used up 15 years from now, that ground lease reverts back to the owner of the commercial building. So there's real sort of financial, upside in partnering with the LIHTC. And the rehab of the old commercial building is a build-to-suit for a refugee-oriented, workforce training program that targets sort of helping refugees commercialize kind of the culinary traditions that they bring from their home countries. So really impactful, kind of interesting use of the space. You can look at the scoring that we put on this project here. Affordability, obviously all the units that are being built are at 30 to 50% of AMI, so deeply affordable units. Just, on the sustainability side, this is going to be an all electric build. It's an adaptive reuse of an existing kind of industrial building, which when you look at a sustainability or environmental footprint of a development project, anytime you're able to do an adaptive reuse, it just has a massively positive, impact as opposed to scraping something and building brand new. So it scores high in that category as well. Anyway, just wanted to give you kind of a flavor of how we kind of apply the tools. I haven't shown the dashboard of what we're doing with the developers to measure ongoing impact performance, but we have those in place and happy to kind of offline that with anybody that's interested. Last thing I'd say really quickly is, one other innovation that we've put in place is we actually condition some of our asset management fees, so some of the economics that we have with our developers around, impact performance. So those metrics that we put in place with the developer, a portion of the economics that they're getting out of the deal through us are tied to their performance based on those metrics, which we think is pretty, innovative. Anyway, that's it for me. I'm excited to catch up more on the Q&A. Thank you.
Yeah, Jeremy, that's super smart. And I actually hadn't heard that before, that you guys are tying developer fees to actual performance. I mean, that's that true pay for performance model. And really, you want to ensure that you're securing the impact that your investors want to see. And it's a way to help leverage that to make your investors happy. I think if we go to the next slide, we can transition to Reed. Yeah,
Thanks,
excellent.
Rachel.
Yeah, go ahead, Reed.
Yeah, thanks for having me on this call. Hello, everybody. My name is Reed Thomas, and I work for a company called NES Financial, which is actually owned by a larger company called JTC. And I'm going to talk to you a little bit today about our approach to this initiative. It's a little different than a fund manager approach, and so hopefully you find that interesting. Next slide, please. So just a little background, we're actually a technology company, and we got started with this mission that from time to time, there's investment initiatives that get created that are well-intended, but in many cases, they fail to do the good they're intended to do. And what we thought we could do is bring some technology to it to help provide enhanced security, transparency, compliance to all the different stakeholders involved in the initiative. And so what we did was we built a platform that we can configure to be purpose-built for these very specialized types of funds. And so opportunity zones, we look at that as a very special kind of fund because it's, on the one hand, a traditional private equity fund where you have to do fund accounting, financial reporting, and those kinds of things. But in addition to that, it's a tax incentive program that has a whole set of rules and requirements that were, for the first 2 years anyway, evolving, and we needed to stay on top of. And then finally, it's an economic development or social impact initiative. And that is, in our view, fundamental to the overall success of the Opportunity Zone program. So if the Opportunity Zone program is going to be expanded or grow, hopefully, it will ultimately be based on the good the initiative actually did. And so we think it's fundamental to incorporate that impact measurement and monitoring, regardless of whether it's mandated by legislation or regulations. We were acquired by a company called JTC earlier this year that's traded on the London Exchange, and we're very excited about that because JTC is actually a global provider of administration services, thank you, and private client services. So it's a company that's passionate about ESG as part of its overall mandate. And so this gives us resources on a global perspective to really do some pretty exciting things. So we're now, NES Financial is really the US operation for JTC, but we operate now globally, 23 different countries. We administer over $130 billion in assets. Next slide, please. So let's talk a little bit about impact in opportunity zones. When we got into the space, we, as I said, we're passionate about the fact that Opportunity Zone administration really comprised those three elements: fund administration and accounting, compliance tracking for tax purposes, as well as impact and social impact measuring. And it wasn't regulated. So our approach was that we felt that if this was going to be adopted and the initiative was ultimately going to be successful, we needed to figure out how to deploy this in a way that was not overly burdensome on fund managers. I should point out our clients are fund managers. That's who we provide services to. We use our technology to deliver services. So think of us as the back office operation for fund managers that deals with the investor relations, does the back office accounting, provides portals to all the investors and fund managers themselves, et cetera. And so our approach was, if it's going to be something that's not a burden, we really need to figure out a way that we could develop something that could be applied algorithmically to the normal work that we're doing anyway, right? If we're doing the accounting and back office reporting, how can we use that information enhanced with our technology to actually do impact reporting and impact scoring? And so what we did was we, sort of searched the industry. At least my personal observation was that there's a lot of folks doing great things. Many of them the vast majority of them were highly customized to a specific firm's passion, which is okay. And others were really more oriented at something where you might have, if you're a fund manager trying to do this, you might have to hire a consulting organization to help you with this, which to me anyway didn't really seem like it was sort of low cost or something that could be done easily by everybody. So in our search for solutions, we came across something that at a company called Global Impact. Global Impact, it was founded by Howard W. Buffett, so the grandson of Warren Buffett, to kind of connect the family tree. And Howard is passionate about measuring impact and had developed something called impact rate of return. So you'll notice it's a little IRR as opposed to the financial version of it. But the concept is the same, where for every dollar of investment, there's some percentage of impact that's generated. And this algorithm, this IRR standard, really becomes a way, regardless of what the project is or what type of project it is or who the fund manager is, to sort of normalize and measure impact in a way that's objective and comparable and standardized. And what we really liked about it was that it was something that we could develop an algorithm to. So what we are doing, because we're administering the fund in the first place, we know the size of the capital stack, we know where money is going, we know how it's being spent, and those kinds of things. And so as a result of that, essentially as a byproduct of what we're doing anyway, we're feeding this information into this algorithm and producing this scoring methodology. And so our approach was really, and this is, I liked the way Jeremy said it better than I have typically said this, but this sort of, he talked about 3 phases. We've sort of talked about something similar in different words. What we do in our solution is we try to establish a baseline. So we know the census tract where the project is. We know, so as a result of that, we can determine immediately, okay, so what is the current environment in that area? What's the unemployment rate? What's the education level? Many different metrics we can pull together. So we established this baseline for our clients, and can sort of show that as this is what it was before we made these investments. We know second area is sort of making a projection of what the impact is going to be. And what we do to do that is we know the project type, so we know what obviously is going to be done. We know the size of the capital stack involved. We know where the project's going to be located. We know over what period of time. We can feed all of that data into the impact rate of return algorithm, and we can come up with a projected score. And it's not limited to just impact rate of return. I'll show you some example screenshots of some of the things we're doing. But some of the other items are highly customizable, right? So if you are passionate about education levels or affordable housing units or something, you could actually track these things. Then the third bucket is the third thing we're focused on is, once we've established sort of the baseline, projected secondly what we think this initiative will accomplish, then what we can do as money moves, again, we're involved in that process, we can feed the movement of the money into these different algorithms that are out there, including the IRR algorithm, and actually score projects towards the ultimate goal. So this is something that we've built into the system. We do it at no charge to our clients because we're passionate about this. This is part of the overall success of the program, because we really believe that the long-term success is going to ultimately be dependent on this. Next slide, please. So here's a screenshot. I just have a couple. There's many more things to our dashboard. And I'm sure somebody in our organization would be happy to show anybody, give anybody a complete demonstration if they're so inclined. But this is an example of what we do. So the dotted line across the top basically represents the targets that have been established, the projected targets for this specific initiative. So in this example, the impact rate of return is forecasted to be 15%. You could see the number of jobs that we estimate this project would create, and some of the other items. And all of these items can be highly customized, right? If it's a student dorm or something to do with agriculture or some other kind of an investment, you obviously don't have to show hotel rooms. You could show some other kinds of metrics. Some of this data is obviously very algorithmic, based on money that is actually spent. So we can calculate direct, indirect, induced jobs as an example based on money spent. But other things like hotel rooms created and the like, we need a sort of a feedback loop at the project level itself to actually update that on a regular basis. So you can see kind of the targets in the dark purple. And then impact to date is the blue color, and that's basically being done on whatever sort of cadence our clients want us to do. Be it annually, quarterly, or even monthly for that matter. Some of these items might actually have meaningful progression on a monthly basis. So next slide, please. Yeah, so what I showed you before was really a screenshot at a project level. So many funds will do multiple projects, right? So it's important to look at this at two ways. One is a project by project way, which is what you saw before. And then, if you have multiple projects in a fund, you need to be able to roll that all up into an overall fund view. And so that's what this is showing you, is that depending on how many different investments you have going on, we're constantly feeding that data back in to the overall calculation for the fund. So you can represent it. So our thought was this would help our clients work closely with sort of an economic development group within a local community, where that group would be very interested in the impact of a specific initiative, but also dealing with maybe policymakers or broader industry initiatives by showing the benefits of their overall fund on a broader perspective. So that's what I wanted to share today. I know we're limited in time, so I'll stop there. I think this is my last slide. And oh no, sorry, I got one more. So I think one of the things Rachel wanted me to talk about was trends. And so in terms of trends, what we've been seeing is a couple of things that make me very excited about the trends in the marketplace and how impact is becoming center to everything here. So if we run our own sort of quarterly webinars and events. Every time we do that, we ask the audience, what their primary motivation for investing in opportunity zones is. And social impact has never been the highest driver, to be honest, but it's a significant percentage of the overall, as you can see scored on the axis there. But the interesting thing for us is that it kind of seems to be on this steady increase. This is probably across a sample size now of 3,000 or 4,000, I would imagine, because it goes back to when we started doing this in 2018. The other thing that I think represents that impact is becoming important is the distribution of the sizes of funds. Rachel talked about intentionality. When the initiative first got kicked off, there were some very large funds that got created, $1 billion, $2 billion kinds of funds. And as time has progressed, the size of the funds we've seen is trending generally smaller. And I think what's happening is the fund sizes are getting smaller and the projects are getting much more focused, which is consistent with a very intentional approach to doing projects that help in certain communities. So you could see, based on just the way this chart is laid out, that the most growth in terms of fund size tends to be in this $10 to $25 million range. So very small targeted funds, which is consistent with the increase in interest in making a social impact. Sorry, that is my last slide, so thank you.
Thanks so much, Reed. And I just really, before we move on, want to underscore the importance of what NES Financial has done here by working with Howard to basically implement the IRR tool into the services that they're already providing and making it available on a tech platform. In my view, the importance is that it is putting, or I guess it's lowering the barriers to impact reporting and evaluation for a number of funds. Because if you think about it, if each of these opportunity funds were to have to do this work themselves and create their own proprietary impact measurement tools, they may not be doing it, number one, because it may be too costly. And so it's helping other folks that are interested in impact, but maybe it's not the main driver of the business that they're doing, understand the impact that they're having. And so I just want to say that, and hopefully Reed agrees with that, with what I just said. But
of course, thank you.
All right, so we have a few questions. I know we're getting some questions in the chat box as well. If we could just go back one slide here. Thank you so much. So this is really to both Reed and Jeremy. I'm just going to pick a few of these questions, and please feel free to hit on any of the topics listed below. But what are you guys seeing as far as in the opportunity zone marketplace, fund managers that are now starting to look for double bottom line investment opportunities? And I think Reed spoke to some of the trends we're seeing around fund sizes and desired impact, but just curious if you could, put a number on it. Is it the majority of the market? Is it, just a increasing percentage?
From my perspective, I'll just go real quick. We work with now, I think, a little over 100 funds, and I would say that it is not the majority. The majority of fund managers is really focused on providing market rate returns or better to their investors. However, I do see it growing, as I indicated in the other slide. Right, the data is trending in this direction.
Yeah, and I would just add to that, say, I think that's right. I don't have the data set that Reed has, but just in my kind of anecdotal experience, there's, we tend to bump into the same kind of 5 or 6, mission aligned, fund managers out there. Unfortunately, because I think it's a, kind of a big, untapped opportunity, if you will. And I guess sort of chaining on to the next question that you got here on the list, like, what's amazing to me is I think there's a big disconnect, because while on the one hand you have, I think, very few, relatively speaking, fund managers that are focused on this and intentional about it. On the one hand, on the other hand, I think you have enormous investor interest in this. And I said at the outset, and I maintain it now, that I think one reason we've been successful is because we've just had this very kind of clear-eyed focus on community benefits and impact. And I think that has resonated, a lot with investors. And these are by and large family offices that are thinking about this. They're factoring this into their kind of capital allocation decisions, generally. And so opportunity zones just become kind of one, sort of sub strategy within that larger, double bottom line strategy that they're taking on. RIA platforms, so wealth distribution platforms, where you have, a bunch of family offices that sort of work with one group to place their capital. Those groups are increasingly hearing from their clients that they want to see more kind of impact-oriented product on those platforms. So those RIAs are becoming, I think, hungrier for this. Even the big kind of institutional wirehouses, the big, investment banks, same thing. They're hearing from their high net worth clients that they want to see more of these types of opportunities. So I think it's a huge, from a capital perspective, it's a huge, untapped market or undertapped market. Sorry, and the last category I should say really quickly is CRA banks, right? Everybody, knows kind of what the CRA, incentive looks like. We have now tangible proof of CRA banks starting to allocate into opportunity zones, just because it's such a tight, there's such tight alignment there with their kind of regulatory mandate, and then with the kind of work that fund managers like us and others are trying to do in those communities. So I think it's something that folks should sort of embrace. Rachel, really quickly, I think you put your finger on it, though. There are a few sort of barriers to entry there, and one of those is around kind of impact measurement and analytics. So I agree with you. I love what Reed's doing. I love the notion of trying to kind of make this easier for people to adopt and put into their their business models.
Yeah, and it's been interesting because from an investor perspective, and Jeremy, you're closer to that side of the business than we are, obviously, because our clients deal with investors. So my information is somewhat secondhand, right? But it's quite interesting to see how our clients want to be able to show a variety of different metrics, and that's where it starts to get hard, right? Because obviously they want to market their fund on the one hand, right? So they want to show things that are make them look good. Nothing wrong with that, because they are making an impact. So let's highlight the areas where we're good. From an investor perspective, families in particular, they may have certain passions or initiatives, and so they want to be sure that there's certain things that are tracked. Somebody chatted in a question, and I'll paraphrase here: what the heck did parking spaces have to do with impact, as an example? And the point is, it's really trying to get to that point, right? Which is if you live in a certain community, maybe parking is a real pain, and it's, it affects your quality of life because you want to go down. Like I live in a little community where there's a nice little downtown, right? And if you want to go support those small businesses downtown, it's a real pain if you have to park half a mile away, right? You just kind of want to pull up and park in front of the shop. So maybe for this, if there's ever a project going on in this community, maybe that's an important metric. And so you need to be able to absorb and deal with those specific sort of odd things at the same time as doing something that can be algorithmically created.
Yeah, that's right on. And, Reed, to your point about the parking spaces, or the question about the parking spaces, if it's being financed with OZ Capital, it's good to measure either way.
Sure.
So independent of whether there's, I think you explained it well around the impact and the argument for the impact there. But, and Jeremy, to all of the points you made, I think you just went down each bullet point.
Sorry.
Covered it. So from here, I'm actually going to go to one of the audience questions, which is really thoughtful and something that I haven't given much thought to, but curious if you have. So, the Impact Act is a bipartisan piece of legislation that was introduced by Tim Scott in the Senate, I guess this time last year. And it really is sort of the leading proposal around reporting requirements and offers a framework for that. So assuming it passes, opportunity funds are going to have to be thinking about what that framework is and what they're going to have to report on. Have you guys given any thought to the different metrics associated within the Impact Act framework? And are you guys monitoring that thus far?
We're paying attention to it for sure. In terms of reporting, we haven't really thought much about, how it's going to look when we report it. We've just really been focused on making sure we have the types of raw data that would be required. So that's the approach that we've been doing, and we think we map out pretty well against that. So as those things kind of evolve, we add additional capabilities to make sure we're tracking the right data, and we'll be able to report on it in any format that's ultimately required.
Yeah, I would echo that. I mean, I think this becomes kind of a competitive advantage, frankly, for people that are early adopters of the kind of frameworks that we're talking about. Right now, there's no regulation that enforces this. I would argue that there are market forces that should, get people thinking about doing this anyway. But if we get an environment where there are regulatory, mandates, I think people that, figured this out early are just going to, continue to outperform. And so we welcome, efforts like Senator Scott's, and I think we're going to be well positioned to, do well in that new environment. And, hopefully groups like Reed's are, sort of facilitating the kind of mass, widespread adoption of these kinds of things. Because right now, I think, Rachel, you put your finger on this, like if you're really inclined to do this and want to put the extra energy and effort into it, there's a path forward, there's a way to do it. But we need to kind of reduce barriers to entry and just kind of, make it more mainstream and more approachable for people that don't, have this on like the top of their to-do list every morning when they wake up.
Agreed.
Yeah, absolutely. With 1 minute left, just any final thoughts from our guest speakers here?
You asked about impact themes, and I would say that the biggest theme is probably measurement. You're seeing even the big four accounting firms trying to set standards for measuring and tracking this type of stuff. And so clearly that's the big theme. Within OZ, we see a lot of housing activity, affordable housing related activity, increasingly agricultural related projects, and renewable energy types of activities. And I think that on why is analysis and transparency important, I think it's business 101, right? You get what you measure. So if you want something done, you measure it and you pay attention to it.
Yeah, and I would just really quickly on the kind of emerging themes or popular themes or trending themes, I guess, in impact, I would point to healthcare, sort of the intersection between kind of working in, underserved communities and, bringing health services into those communities. And you have, I think at the moment, big health systems looking to go kind of further upstream in the life cycle of a kind of a health problem and going into lower income communities and providing services earlier. they don't necessarily talk about that in terms of impact, like they use different nomenclature, but I think people that are smart and kind of figure out how to translate between health systems and, people that are putting capital into communities like this, like there's a ton of opportunities to partner with big health systems that have an aligned set of incentives.
Yeah, completely agree. Both the preventative health piece and also behavioral health. Just want to plug a group that won the Investigatiana OZ Pitch Fest last night. I was able to serve as a judge on the panel, but it's a behavioral health center with a high demand in New Iberia in Louisiana. So if folks are looking for an investment opportunity, I think that's a good one to take a look at. So yeah, we are here. And with that, if folks want to get a hold of Jeremy or Reed, contact information right there. And go to our OZ resources page for a recording of this blog next week. Thanks to you both. Really appreciate it.
Thank you,
Thank
Rachel.
you.
This has been great. Thanks to everybody for listening. Have a good day.